Research stops right here. Join Mukonke Insight Partners Africa every Tuesday at 0:20 hours. Essence a program that gives you the best and most practical, actionable insights.
It is a good morning and welcome to this edition of the Ndalama Insights radio show on ZMBC's Radio 4. Today we are tackling a critical issue that's affecting many Zambians, and that is how rising interest rates impact your personal loan. As always, we're joined by our financial expert Mokonke Mokonkela from Insight Partners. Mokonke, it is a good morning and welcome to the show.
Leslie, good morning. How have you been?
Very well, thank you. And how are you?
Great, thanks.
Great.
Yeah.
This loan issue is a very big issue. We've been receiving numerous messages from listeners expressing concerns about their loans, and many are finding that despite making regular payments, they're barely making a dent in their loan balances. What's going on?
Thanks, Leslie. This is a big issue, right? I'm sure you've heard of complaints, people complaining even on various social media platforms about, I have a loan with this bank, and it seems not to reduce. In fact, it's increasing. So when we look at personal loans, even business loans, actually, we need to understand, particularly in Zambia, that our loans are based on a variable interest rate, meaning that whenever the Bank of Zambia increases the base rate, which is also referred to as the monetary policy rate, it affects the loan that you have. So it's very important for us individuals that are trying to manage our money and we've got a loan to understand the basics of these loans. And the very starting point is for us to understand that our loans are based on a variable interest rate, meaning that whenever the MPR base rate changes, it automatically is going to affect our loan. And so that is what this discussion is really about, Leslie.
All right, now, let's talk about the actual numbers. When we talk about this MPR, what numbers are we talking about exactly?
So recently, I think the MPR right now stands at about 13.5%, and it was increased by 1% recently from about 12.5%. So what this means, Leslie, is that your loan, if you've got a loan, maybe 500,000 kwacha personal loan, and you were paying an interest rate of 12.5%, it meant that you were paying the 12.5% per annum on that 500,000. When Bank of Zambia increases the MPR, because it's a variable interest rate, it's not fixed. It means that your outstanding loan balance is going to be computed on the increased interest rate. So, for instance, if the interest rate, the MPR goes up by 1%, even your loan interest rate, the banks are definitely going to increase the rate. If you are borrowing, let's say, at 25%, they may also increase the interest rate maybe to about 26% to match the increase in the MPR. Now, because your loan is computed, your outstanding loan amount is computed on a variable interest rate, it means that your interest is going to increase. Your interest repayments are going to increase. And even as you make repayments, you might not see a dent in terms of reduction in your loan amount as a result of this.
Now, how does this translate to actual loan repayments? I mean, these look like very small figures: 1%, 2%, 3%. But how does that then affect your loan so much?
So let's look at an hypothetical example, Leslie. If say someone took a 500,000 kwacha loan for 5 years in 2022 when the interest rates were lower, and their monthly payment might have been around 12,800. Now, if that rate is increased, let's say by 2%, their monthly repayment could jump to about 13,000 kwacha 500. That's an extra 700 kwacha per annum. Okay, that wasn't planned for when you were borrowing at a lower interest rate in 2022. So that is how the increase in interest rates affect your loan amount. The key point here is that because your loan, your outstanding loan amount is not based on a fixed interest rate, it's based on a variable fluctuating interest rate, which is tied into the MPR. Any increase in the interest rate would definitely affect the interest amount that you pay.
Okay. Those are significant numbers, but some people are talking about more dramatic changes, like loan terms being extended. How does that work?
Yeah, so those are strategies that banks try to help their clients in order to manage their loans. So they will recommend that you extend your tenure. However, we need to be careful with that because extending your loan tenure could actually result in more interest rates. And so that is a suggestion that banks make to you. So you've essentially got two options to manage your loan in an ever increasing interest rate environment. You could either increase the tenure of the loan, meaning that you're increasing the repayment period. So for instance, if you were meant to repay a loan in 60 months, the bank might suggest to you to repay it maybe in 70 months. However, that really affects the amount of the loan and interest rate that you're going to pay. The other option is to keep the period, the tenure the same, 60 months, but increase the loan amounts that you're paying. So if you are paying, let's say, the 12,800, you could say, I want to keep the 60 months, but I'm going to increase the amount. Instead of 12,800, I want to be paying 14,000 or 13,000. That is a better route. Yeah.
Wow. Numbers is staggering. When you actually think about it, it's actually quite a lot of money these 2% adds. Now, higher payments or much more paid over time. Is there a way out though? Is there another way out?
Yes, there is. I think, first of all, the most important part, Leslie, really is the starting point. You need to understand how your loan is structured. And sometimes, if it's possible, really, if it's possible for you to fix the interest rate, I think that's my suggestion. But I've rarely heard of personal loans that are on a fixed interest rate. The other way you could look at it is to shop around. So rather than just focusing on one commercial bank, before you sign a loan agreement, you need to shop around and see if you can get a better interest rate, because these interest rates are also different. It's not the interest rate is fluctuating, but banks offer different rates. You may just find a cheaper loan that might be better for you rather than just focusing on the bank that you're banking with. You need to really shop around and ensure you get a loan that has an affordable interest rate for you. And most importantly, understand the loan terms. Oftentimes, we're so excited to get these loans that we really look at the terms, and sometimes they even in the banks entice us and say the first month maybe is you don't need to pay anything, and you get so excited by if you listen to that. So really pay attention to the loan terms, because that's where you are able to see how much interest rate you are going to pay and overall the total cost of the loan, and see whether that total cost is worth taking on the burden, especially even in a never increasing interest rate environment. Are you able to keep up with changing interest rates? And do some calculations in Excel and see. So if inflation, because interest rates rise because of inflation rate, so the central bank is trying to control inflation rate. So if the inflation rate is increasing, you definitely expect interest rates to go up. So do some calculations, look at different options. If interest rates are to go up, how will this affect my personal loan? And look at different scenarios. If they went up to maybe 14, that's the base rate, 14%, how will this affect my personal loan? If the base rate had to go up to 15%, how will it affect my personal loan? That will help you to determine whether you are actually able to afford that loan or not. Yeah.
And Zambia's base rate is just high. 11%, because when you look at base rates of other countries, it's like 4%, 3%. I guess it's a discussion for another day.
Yes, it is, but that's an important point, Leslie. For me, I always say loans are good, as everybody knows. If you can use other people's money to make your money, that is the best way. Who wouldn't want that? And for countries where interest rates are lower, like 3%, I mean, who wouldn't want to get the loan? So, but Zambia is really a tricky country. And if you look, I've got a response from online from Peter, who's saying, thank you for the insights. Over the years, I've come to understand that getting loans is never a good idea unless otherwise. So, and this is because of the high interest rates that we have. Look at it. On average, 29%, even on business or personal loans. That's huge. And so we really need to consider the terms and consider the necessity, and if we are able to afford to repay back the loan.
Oh, it was 30%.
Mm.
Can you imagine? That is a profit margin of a business. So you are there trying to supply something, you get a loan, you're paying back 30% interest rate. Then what's your profit on the loan?
That's the question. That's the question. And I like that you're looking at it also from the businesses, particularly the SMEs. Increased interest rates really affect the operating costs of a small business. If you look at that 30%, what the question really is, what's your gross profit margin? And that's like the pure profit before you even consider the administrative expenditures. 30%, then what about your net profit, your overall take home? What percentage are you making for you to be able to afford a 30% loan? Those are good questions to ask. Yeah.
Now, let's look at, now those who haven't borrowed, don't have a loan, but, they're intending to borrow. I mean, here it sounds like all doom and gloom when you borrow, but for our listeners who don't currently have loans but might be considering them, what advice do you have in this high interest environment?
Really, you need to assess the necessity. For me, that's just the baseline. Assess the necessity for that loan, and also consider your sources of revenue. How are you going to repay back that loan? Because sometimes we tend to think maybe it's free money. The fact that I can get it, maybe I can run away from repaying back. And then when the financial institutions start calling for their interest, their loan repayments, interest, then we start crying foul and forget that we actually signed a contract for this loan. So really consider the necessity, and if you're able to afford this loan. It's not just an issue of can I get the loan. I think the most important question is, can I afford the loan? Many of us would love to get the loans, but very few of us can actually afford the loans.
And that is definitely a big problem.
Yeah.
But how does this high interest environment affect the broader Zambian economy?
That's a really, really good question. And for the economy, this results in reduced spending because, if interest rates are increasing, it means that more money is going towards repaying back loans. And so you cannot spend money that you don't have, particularly if an expenditure area has increased. So you need to reduce your spending. And also, increased interest rates discourage businesses from investing because they cannot afford these loans. So for SMEs, and Leslie, I'm really passionate about SMEs. For SMEs, this affects their expansion. They cannot invest in areas that are critical for expansion because of the high interest rate environment, and that they can't afford really to take on these loans. And so this is how increased interest rates generally affect the economy. You see, in other countries, and Zambia is really peculiar, in other countries, when interest rates are increasing, we also say it encourages savings because we hope to see an increase on our interest rates on our savings. We hope that the banks will also increase the interest rates on our savings. But honestly speaking, I have never in my 40 plus years of life seen that. I don't know, maybe I'm in another planet, but it's supposed to work both ways, Leslie. But it really does. What we see is the loan costs, interest rates going up. We don't see that in terms of our savings. That doesn't trickle down to our savings because we're also supposed, those of us that are saving money, we're also supposed to see an increase in our interest rates on our savings. But that rarely happens. But as usual, Zambia is really peculiar in many areas.
The interest rates and savings, really. I mean, that's why we start talking about treasury bills and bonds and so on and so forth. Because the interest rate in savings, really, most of the time, if you are talking about, money less than 10,000 kwacha, you have less money at the end of the year.
Yeah.
Because of bank charges and what have you. So at the end of the day, it's why are you saving the money? As I said, conversations
for another day. For another day. Here's another feedback from Wanza online. He said, "Good morning. This MPR thing isn't well explained in banks. However, the best is to maintain the tenure and have an increase in the amount. 5-year loan can even take up to 8 years to repay due to MPR." Then that's very true. For those that are not aware, if the bank recommends to you to say, can we increase the tenure? really think about it critically, because it's going to result in an increase in your loan if you increase the tenure. The best option, if you can afford, is to increase the amount. Now, the question really is, can you afford to increase the amount considering the situation and the circumstances? And that is why many people consider increasing the tenure, because it's more flexible for them. But in the long term, it's actually more expensive. Yeah.
But I think as well, when you look at standard salaries for most, I mean, I'm not saying everyone gets paid around the same figure, but you've got the standard rates of loans, especially within Zambia's context, is 5,000-6,000 kwacha. So when they do these MPRs, the difference will be 300, 400, 300, 400. So I think it is something to consider, isn't it? Better than saying add tenure, because tenure gives you an extra year. Every now and then to give you an extra 7 months. It's quite a lot. It's quite a lot. When you think about the 300 kwacha, it looks like it's a little because you're thinking about it monthly. But I think it is better because at the end of the year, 300 kwacha will translate to what? 3 times 12, 36, 3,600. And 3,600 is almost a month's pay. So it's like if your loan has got 4 years to go, it's an extra 4 months you're adding. But it's a way to think about it. I'm trying to think about it as well because I'm also one of those victims. It's very interesting.
No, it's really a way to think about it. Increase the amount rather than the tenure, because overall the tenure will result in an increased loan balance, and it will make you feel like there's no dent in whatever payments you are making, repayments you are making towards your loan. So the best way to fill the dent is to increase the loan amount if you can. And as you've given illustrated with the 300 kwacha, which results into 3,600 per annum, that makes a huge difference. And so I hope this really, really helps the listeners that have been struggling with commercial bank loans. And every time the MPR goes up, I receive a message, we are going to increase your tenure. Rush to your bank and tell them, rather than increase my tenure, let me increase the amount, maintain the tenure.
Well, interesting. As we approach the end of our show, though, what final advice would you give to our listeners, about navigating this high interest environment?
Really, we can't run away from it, and as much as we complain, the very little can be done about it, because our loans are based on a variable interest rate. I wish one day we are going to have fixed interest rates. However, the best you can do really is to educate yourself more about these loans. Always listen to the news whenever the MPR goes up. Consider how it affects your current loan repayment, and consider if you can increase the amount rather than the tenure. That is the best way to get around managing this ever interest changing environment. Yes.
Great. Kalki, once again, thank you very much for coming to the show.
Thanks, Leslie, and thanks, dear listeners, and have a fantastic morning, all of you.
Okay. This has been the Ndalama Insights Radio Show.
You have been listening